Matt, just to help out our listeners, can you explain the key criteria to ensure that our listeners are ticking all the right boxes? Now, this is really, really important when applying for those loans. What are the key criteria that they should be taking note of?
So the three main criteria they look at. One is credit. So they'll we do a credit check on all of our clients straight away, just so we know what are we playing with, what entities do we have, what directorships. It also gives us a score. And the other thing the credit report gives us these days that it didn't used to, it gives us any live facilities. So any lending credit facility that's live at the moment, probably 95% of them anyway, will show up on your credit report. So we can have a look at 24 months of conduct on every live facility that you have, that if you're in your personal name or if you're a director of. So it's a pretty powerful tool. We have a look at that straight away, and we just make sure that there's nothing there that we don't know about. So that's if your listeners have not had a look at their credit report, you can get a free one. It takes about a week or so to come to you, but you can go on to, if you just Google Equifax, there's a couple of other ones, but Equifax is the main platform that the lenders are using now to have a look at people's credit. So I'd suggest have a look at your own credit. If you can't, feel free to contact us, and I'm happy to get our credit report sorted out for you. The second search credit, once we tick that box, we move on to equity, and we understand what the bank's proposed equity position is based on what the valuation is, and then we roll that with the loan amount or the proposed loan amount. So most lenders will let you go to up to a maximum of 80%. Now, there are some exceptions to that where we've got medicos and other professions, accountancy, some legal as well. There's some lenders that are legal. They'll let you go a little bit higher. So they'll let you borrow up to, sometimes it's 100% and more. There's a couple of little asterisks with that, but just know there are options if you don't have equity, but you are interested in getting into the commercial property world. There are certainly options there depending on what your profession is, and feel free to have a chat. So we've got credit report, we've got equity, and the next one is your borrowing capacity. So borrowing capacity is probably the area that we spend most of our time on. It's a minefield of opportunity, and if you get it wrong at the wrong lender at the wrong time, you can decrease your credit score. So every time we put a credit application in, there's a number of points. Generally, we think it's 30 to 40 points. They won't ever give us the algorithm, but that's anecdotal from lots and lots of applications that we've made over the years. So you don't want to be going and making too many applications. You really want to do the research first, pick one lender, and we generally don't submit a loan unless we know reasonably well that it's going to go through, so that we know that security property is able to be taken by that particular lender. They like the location. They agree with the LVR. So we've got agreement on that location, that type of property. That's a max LVR. And generally, that'll be 75%, but we do have lenders that will go to 80%. And then we do have lenders that will go to 30-year terms as well. So it just stretches out that cash flow a little bit. But they're the three key criteria that we're looking at. We've loaded some financing mistakes to avoid there as well. We talk about the BLT, the bank loyalty tax. Sometimes the best rate is a false economy, because they can catch you up later, and they may impose 15-year terms on you rather than 13-year terms. So that can squeeze your cash flow. It can also impede your borrowing capacity. They also may put an amortization clause in there where you have to get 5 years interest only, and then you've got to start paying down the principal. So just know there's so many different policies that chasing the best rate is not always the most suitable product. And again, we address that on a case-by-case basis, just by highlighting what some of the opportunities are, to particularly where people are looking to grow their portfolios and or improve their current portfolios. One of the other points I put there was not thinking ahead of the current transaction. So we see a lot of people that solve their immediate issue just by going back to their banker, but then another opportunity comes up, often in the same geographical area and or of the same type of property. So if it's industrial, sheds or whatever it might be, but they'll find another one that meets their same criteria because they've already done all the homework. So we just say, look, have a think about what ideally you would do, or if you could do it. And then we start to work backwards and reverse engineer it. So improving borrowing capacity is probably, as I said, where we spend the most of our time. We like to spread lending across lenders. So I've personally got about 5 different lenders that I use for my portfolio. And I don't like to give them too much purchase on anything because they can not like something that's happening in a particular area. I had a commercial property up in Cairns. It was just a retail shop front that we used in the law firm we had many years ago. And I kept that one for a number of years, but the tenants stopped paying. So we had to roll with that. Unfortunately, that did impact some of our residential stuff that we had because we were with the same lender. So there's just some learnings that we've had over the years around spreading your lending out to make sure that your lender doesn't have too much control over what you can do inside your portfolio.
And that's always, we always talk about cross-collateralization. If you can avoid it, then avoid it at all costs. As Matt's just indicated, I mean, if one bean falls off the cart, it affects all the others, basically.
There's some clever ways still to get access to that equity without cross-collateralizing it. So that's important that people know that it doesn't take that solution out of play. You've got equity in a property, that's great. We just got to work out how we get it out and then place the next deal somewhere else.
So what would you say, in your opinion, what would be the best way for our listeners to, in relation to improving their borrowing capacity? What would you recommend? A couple of key notes, what to do. A couple of lenders that I've spoken to in the past have said, if you've got any credit cards, just pay your credit cards off and cancel them while you're busy doing your loans. I mean, that reflects on your credit rating, and it's a silly little thing that most of us don't even think about, but actually it's one of the things that does impact on your loans.
Just little things where if you know what you've got access to and you know what you've got. So sometimes you just forget, like you've had a credit card for years. That's a great example. That's the most common one we find. The other one is debt consolidation. That's a really big one. And this is particularly for self-employed people where I might buy my office and then I have some leases for cars and then I have some equipment. Now, if that's all wrapped under, and there's horses for courses here, so I'll put a caveat over this one, but it's one that we see a lot. The individual cost of each one of those adds up to a really large number. So that impacts your monthly cash flow. When we're assessing borrowing capacity particularly, we have to look at what income do you have coming in against what expenses do you have? And the bank always wants a little buffer. So where you've got 5 debts, for example, that are all, one might be 5 years, one might be 3 years, one might be 15 years, another one might be 30 years. If we can get that all under one umbrella and spread it out as much as possible, we just make an instant improvement to your borrowing capacity. It's just incredible. So debt consolidation would be, after doing a credit report, to work out, okay, what still resides on your credit report? Because often they get it wrong too. We've found countless errors that loans just, they're not there anymore. It's gone. So we go, okay, well, let's take that out, get it removed. And then we start to look at, okay, what's the lender going to look at now and how are they going to view what they see? So we just make sure that we know what they know. And then we start to strategize and go, okay, let's have a look at consolidating some debt and bring it under one loan amount and stretching that right out. So that can make a massive difference. Other things that I've popped in there, rate reductions. So if you've got an existing rate, let's just trim it right up. And if they won't trim it up enough with what's competitive in the market, then we refinance it and take it somewhere else. You probably find yourself with a cash back, So not only will you save money, but you'll actually have money back in your pocket that, you can go and buy those new golf clubs or take a weekend away, but there's a lot of competition. The other thing I put there is just reducing your monthly living expenses. Sometimes, this doesn't always happen in the commercial world, just depends on how the structure looks. But if there's lots of different lending things that they're looking at and they want to assess that, particularly the majors, they're the most scrutinising in how they go about assessments. And this is why sometimes we look to use non-bank lenders that are a bit more lateral, a bit more flexible, because they won't go through. They're looking for reasons to write a deal, not looking for reasons why we can't write a deal. So it just depends on where they're at in their cycle of book balancing.
Yeah, that makes a very big difference.